Want to analyze the markets but just don't have the time? That's why we're here to help. Hi, this is Steve Graphman Rumsey of Optimus Advisory Group, here to present SpeedGraphs. Let's get to it. So first off, we're talking about inflation. So this is Truflation's website. They track inflation real time. Had some great numbers most of 2025. Unfortunately, it pivoted and is starting to head higher. So the last thing we want to see is this to head north of 2% again. But right now, we're still in the good zone. Next up, the dollar. So the dollar's had a nice run up since the financial crisis, peaked recently, then it drastically dropped all of a sudden from 110 down to below 100. So people started to get concerned about the dollar's weakness. So we continue to monitor this as well. Next up, unemployment. People are used to U4, that's the headline number. I like to use U6, that's U4 plus people that are working part-time because they can't find full-time work, and those that are marginally attached to the workforce. So you can see this is 2 years steady incline. So this is the last part of the Biden administration, the beginning of the Trump administration, and this continues to move higher. Now, here we have a proxy for small and medium-sized businesses. So these are companies that would use, say, QuickBooks and Paychecks. This is research done by Harvard University, Brown University, and the Bill and Melinda Gates Foundation. They wanted to see the damage done from COVID. So January 2020, that's where this starts. You see the plunge during the COVID crash. Then employment rockets back up again, but never regains the old highs and has been trending lower for years. So this is very disheartening because this shows for small and medium-sized businesses, their employment is off over 12% since COVID. Next up, this is an interesting phenomenon. So dotted line, federal employees year-over-year change, solid line, private employees year-over-year change. So the dotted line rarely goes above the solid line unless you're having a recession or possibly a war or something catastrophic. So it almost looks like when the Biden administration saw employment was falling by private employers, they started kicking in more federal employees to fill that gap. So that's why we saw employment numbers that were so strong, which now we can see that dotted line has dropped dramatically. Doge kicked in, but it was peaking and rolling over before Trump took office. So here's the Atlanta Fed. They have their GDP Now forecasting tool. So you can go to the site, you can check where they think GDP is going to be for the second quarter. They nailed it in the first quarter, said we were going to have a negative quarter. We did. Second quarter, they're saying 2.4% growth so far. So we have about a third of the quarter still left. We'll see where it goes. It bounces around a lot, but even top economists are saying over 1% growth for the second quarter. No recession call. Next up, interest rates, 10-year bonds. So this is a concern because not too long ago, we had 10-year bond yields less than 1%. Now they've been hovering around 4.5%, peaked at 5 recently. We definitely don't want them higher. We want this yield to come back down to where it was a few years ago. Keep in mind the Treasury needs to refi, in a sense, trillions of dollars of debt this year. They can't have this interest rate where it is right now. They need it lower because our interest payments are skyrocketing. Now, this affects mortgages. So you could get a 30-year fixed mortgage just a few years ago for under 3%. Unbelievable. Now looking at 6.75 to 7%. So this puts a cap on real estate, and we need these rates to come down as well. Now, a lot of talk about Japan. They went way out on a limb several years ago and started issuing 40-year government bonds. So these things were bouncing around the zero line several times in the last several years, but now have jumped up to 3.6%, which is really high considering they were less than 1% just a couple years ago. So this is causing a big problem for the Japanese government. But they have 10-year bonds as well. So this had negative interest rates several years ago. This is causing a concern because Japan's rates have been so low for so long. Now, let's look at yield spreads. So this is the difference between Treasury bonds and US corporate high yield bonds. In 2022, during the bond bear market, Yield spread spiked. We don't like to see that, but they've been trending down for the last few years until April, and they spiked up again. So people started to panic thinking we're going to do this again. And before anybody blinked, they dropped right back down again. So that's a positive. Finally, internal market indicators for US stocks. So this is large cap advanced decline line since 2023. So we see this steady incline, but this is the chart for small and mid caps. Same concept, advanced decline line. Small caps just can't get out of their own way. Every time we have some kind of a what looks like a new bull market, it rolls over and dies again. So we would love to see this have the same upward tendency as large caps, but it's still about mega caps and large cap stocks for the US. Finally, volatility, the VIX. In the last 12 months, it spiked and hit 60 twice. So once in August last year, when Japan's stock market dropped 25% in a month, and people were panicked about that. And then obviously in April, that's when it spiked up again. Stocks had a huge sell-off, Trump tariffs, all that panic that kicked in, and then it dropped just as quickly as it went up. So we'd like to see it stay below 20. It's bouncing between 22 and 18. So we'll continue to monitor this as well. Thank you for tuning into this. We know your time is valuable, and we know how hard it is to keep up with all the markets out there. As I said, we're here to help. This is Steve Graphman Rumsey. Until next time.